Options give you the right to buy the stock at a future date. Now, many people don't even bother to exercise their options. They simply sell their option at a profit. For example, let's say you purchase this $90 90 strike price option for 20 cents. Well, if the stock moved up to $95, that 20-cent option is now worth $5. That's a tremendous profit. If you were to purchase 10 contracts of that, it would cost you $200. At expiration, if the stock is selling at $95, that option will be worth $5. It's the difference between these two strike prices. $95 minus $90 is $5. That's how they value the option. That option at $5 is now worth, because you bought 10 contracts, is now worth $5,000. So a $200 option you purchased today, if the stock was to go up to 95, would be worth $5,000. Most people would not exercise their options to buy the stock unless that was their goal, but they would simply sell the option back to the market for $5, capturing that $4.80 profit. So why would you sell it? Well, like I said, if on a bull call spread, you hope to be able to have the stock rise past your short strike until at expiration, so that you can collect the full and maximum profit of that spread of $5 at expiration. In this case, we're buying the spread for $2.20. At expiration, that spread will be worth $5, making us a $2.80 profit. But what happens if it doesn't move? What happens if the stock stays at $75? Well, we'll just round it off to $75 for this example. Well, that $3.75 of intrinsic value in this option, or the $4.10 that we purchased, will be worthless at expiration. We will have lost all $4.10 that we paid for it. Not only that, but our option that we sold at 80 cents, at the $80 strike price for $1.70, will also be completely worthless. That's why the maximum loss of a bull call spread is the debit that you paid for it. We will have actually made a profit of $1.70 on this one because we sold it, and if we can buy it back for $0, we keep the difference as our profit. In the case of this option, we bought it for $4.10, so we lost the maximum, or $4.10 on this option. So we gained $1.70 on that one, we lost $4.10 on that one, which gives us, actually, because we're using retail prices here, a maximum loss of $2.40, but we're going to try to hit the mid price, so our maximum loss is $2.20. But the difference is you lose whatever you paid for this spread. Now, when we do the opposite, we actually sell the vertical. We collect a credit of $2.15. Now, what happens if the stock stays the same? It does not move, and it's $75 at expiration. Well, if it is $75 at expiration, we get to keep the maximum credit that we put this trade on for, which is $2.15. When we go to sell it back, when we go to purchase these options, we're purchasing back the 75 and we're selling the 80, we're selling the spread. We hope to sell it for nothing. Hopefully we can just let it expire and we collect the maximum profit. We know ahead of time what our maximum profit is going to be. In this case, it's $2.15. That's the most that we can make on this trade. And our maximum loss is $2.85. How would the maximum loss be achieved? If the stock were to rally up past the 75 and close above $80, we will, which is the price at our long call, then we will have lost this spread will be worth $5, and we will have made our maximum loss, which was $2.85, because $2.15 minus the difference in the strike prices is $2.85. That's our maximum loss. If we bring up the dialog box again, you'll see that the maximum loss is $2.85, or $285. So why would we sell rather than buy these spreads? Well, I'll show you. Let's go to, and I just right click on this order dialog box and go to Analyze Duplicate Trade. Let's take a look at this. When we sell a spread, I want you to take a look at something very interesting. We manage our business based on the numbers. So when we receive credits on a spread order, because we're selling an option that is more expensive than the one we're buying, we're going to have a negative delta. Remember, when you buy a call option, you'll have a positive delta. When you sell a call option, you'll have a negative delta. In this case, we sold one that was more expensive than the one we bought. Remember, we like to buy low, sell high. That's what all good businesses do. So we will have a negative delta. But more importantly, we will have a positive theta. In this case, $1.08. Which means that as time progresses, as we get closer and closer to expiration, we would hope to achieve $1.08 profit every single day that we hold this position, given that prices would remain relatively stable.